Okay, in this video, I'm going to talk about modified endowment contracts as it relates to life insurance policies. So basically, with modified endowment contracts, this is a change that was made to the laws in order to address issues with people trying to use life insurance to avoid or reduce taxes during their lifetime. And basically, I've mentioned this in a prior video. What people were trying to do was use life insurance as another means of saving and investing without incurring the taxes associated with doing that. So basically, what the modified endowment contract rules do is that it actually puts in place certain stipulations to ensure that people aren't really doing that. That when they're buying life insurance, it really is for the purpose of being life insurance. So, in order to ensure that that's the case, there are a few things that are in place. One, premiums that are paid have to be linked to the death benefit amount. So not just the kind of what the cash account has or cash value has grown into the actual death benefit. And then two, there is a like a 7-pay test. And so for a 7-pay test, what this is basically you find the level premium that would make a policy paid up within 7 years, and you compare that to the cumulative premium payments that have been made. And if the policy is paying faster than that rate, and it's paid up faster than that rate, then this is going to trigger that modified endowment contracts criteria. And then that's going to put in place some rules, as mentioned in a prior video, regarding withdrawals, loans against the policy, things like that. So basically, if you pay for your life insurance too fast, then it triggers this. Um, Now, if you make enough policy changes, certain policy changes can also trigger a reevaluation of this in a new 7-year or seven payment test. Um, so that's something to kind of keep in mind if you're making significant changes to your life insurance. Make sure that it doesn't violate that if you're or advising a client or something like that. Now, if you think about kind of big picture here, what that would mean is that typically, if I buy a whole life insurance policy by paying upfront for that, then that would violate this, right? Because that's you paid for the whole thing in one payment. So generally, if you're looking at a single payment whole life insurance policy, that really is going to be more useful for the estate planning kind of purposes. That wouldn't be something you would expect to be able to use to borrow money against or take a or make withdrawals from, because you're probably going to run afoul of the modified endowment contract principles in that case. So it can still make sense for estate planning purposes to do that, but there are going to be some limitations because of how it was purchased and how fast it was purchased. So from that standpoint, that you kind of have to be a little bit careful with that. Um, Now, if a policy is in that category, as mentioned, then there are rules regarding how loans can be done, if they can be done, or withdrawals, and whether that triggers taxes and all those kinds of things, which is beyond the scope of this video. But that's the big picture idea of kind of what's going on with modified endowment contracts. If you were looking at a policy that has some gain, cash value, things like that, that's kind of what this is looking at, right? Now, one area that you would not typically expect this to be a problem would be if you have a term life insurance policy, because you can't borrow against that or make withdrawals from a term policy anyway. But if you're looking at a whole life policy, for instance, then how fast you pay for it is what's potentially going to be an issue for the modified endowment contract situation. Okay, hopefully this video helps. Thank you for watching. Have a great day.